the U.S. economy is in recession. And if you've tuned in before, you know that we believe that Europe and China effectively have been in recession as well. So now a global recession. We're also getting a lot of indicators that prices are coming down. And I think this notion that the inflation that everyone has been worried about is quite a wrong way of looking at the world right now. We believe that deflation is the much bigger risk. We think that the pricing action, and I'm not just talking about stocks and bonds, I'm talking about commodity prices, crypto prices, and perhaps soon even housing prices, that many people will conclude the greater risk is deflation. And Bitcoin, it peaked way back in November at 69,000, and it is now at 19,500. It is still higher than its pre-COVID 7,000 to 10,000 range. And it is just about at its 2017 high. So this could be some support. It's also at, it is below its 200-week moving average, which is at 22,500. So there is some concern that that is the new resistance. Now, as we've seen the last month play out, talk about a reach for yield. Crypto personified that. DeFi personified that. And we knew that the Luna Terra experiment with algorithmic stablecoins was not going to work. It was backed by nothing. I really do try and noodle through these things, and I just didn't think that was going to work. And it failed in spectacular fashion in May, and has taken Celsius down with it, Voyager Digital, 3 Arrows Capital, BlockFi almost. It was very interesting to see BlockFi's last funding round at $3 billion. This is a lending platform. And tried to do another round recently at $1 billion. He couldn't get it done. And today it seems that FTX is going to buy it out, or it has the option to buy the equity for $240 million. A rumor this week had it at $25 million, so much better than that, but much worse, less than a tenth of its last round. And it's not just happening in crypto. Klarna just announced, I believe, that its last round was in the $45 billion range. This is a fintech company, and it is doing around now at $6.5 billion. So big down rounds happening very quickly. We have, or we will put out today, our Bitcoin Monthly. We started it last month. And the title is Contagion versus Capitulation. We have a lot of on-chain analytics which give us a sense of the capitulation in the marketplace, and also a sense of what is going bad out there. The transparency in the market, I think, is the reason we've seen a lot of failures very quickly. We have, compared to the opacity in the traditional financial markets, I think the shakeout in crypto has happened sooner and faster than it would have in the traditional financial markets. It's interesting that BlockFi is going to FTX. We know that 2 other platforms or companies, Leden, which is Leden, which is a lending platform in Canada, highly regarded. The only reason I think people are a bit on edge here is technicians who, those who really don't follow the crypto markets at all. They're just technicians. They follow equities, bonds. They don't care what these companies do or what kind of fixed income instrument it is. They just have their technicals. And just off the cuff, they will say, well, if it breaks from here, it could go to 11 to 13,000 from this 19.5. And the reason they say that, I can see this on the charts, is that's where there is a huge amount of support, where it peaked a lot of times in a trading range. That said, I will say that I am feeling a lot better about what's going on in the crypto world right now. You'll see our Bitcoin monthly. I would say, we're neutral to positive. We're waiting for a few more capitulation signals. And of course, time will tell on the systemic side here. And we haven't heard of another stress signal in the last few days. So that's good as well. What's happened in the crypto market gives you a sense of why it is why it's going to work long run. It's transparent. And there's a lot more trust in the crypto ecosystem because of the transparency and the over-collateralization than I think there is in the traditional financial markets. And when we wonder why are the CDSs going up on these banks, we wonder about the reach for yield and how leveraged some of these situations are. And we don't know where they're hiding. And so maybe that's all this is like, okay, the crypto market has alerted us that this reach for yield went way too far. And there are too many excesses, too much leverage around it. Hedge funds leveraging 10 to 1 when yields are 2% so that they can reach the returns or their return objectives. Maybe there are some problems out there, and we will find out. But for right now, I'm really, number one, that we have so many signals that will get to the Fed in some way, shape, or form, even if they have to wait for the CPI. They will get into the CPI. And that they are suggesting to me that the Fed has already gone too far, and that if it increases rates again, I doubt it'll be 75, maybe 25 or 50. I even think that will be a bit too much given what's going on out there and given the recession we're in. But at least the numbers, and part of this is downward revisions. Originally, the Fed thought these numbers were very strong, consumption very strong. No, consumption's falling apart. So believe it or not, bad news is good news now, as tends to be the case in a bear market when inflation is a concern. So bad news is good news, and it's always darkest before the dawn. And I believe we've passed the darkest place. We don't think deflation is a bad thing per se. It is a bad thing the way the Fed has approached it, we believe. But deflation can be a very good thing if it is caused by technology and progress. And we think we're going to see a lot of that over the years. But right now, we're looking at bad deflation. And we're going to have to get through this. I think the next Fed move is supposed to be at the end of this month. And the Fed is out of its quiet period. So all the Fed governors have been traipsing out saying we're going 75 basis points, another 75 basis points in this month as we get not only more pricing signals, but earnings reports and guidance from companies who will be probably confirming that the U.S. is now in recession. So bad news, good news, darkest before the dawn. We called this segment Finding Growth. We think growth is going to be scarce this year. And as you know, innovation is all about growth. Innovation is also about solving problems. We have a lot of problems now. A recession is going to be providing another set of problems. So lots of work for innovation to do. And that's where we believe you will find real growth. So I did a tweet thread last weekend and basically concluding that the Fed right now is much more worried about its own legacy than it is about the economy. It is so afraid that it has let the inflation genie out of the bottle and that it won't be able to get it back. That it is in unison, basically going out there and saying, we are going to tighten. We have an unconditional commitment to 2% inflation. Well, I'm going to be sharing with you a lot of indicators that will suggest that using the CPI as its guide, the Fed is making a big mistake. There's already a lot of deflation in the economy. And one of the reasons the deflation is accelerating here is because the Fed has shocked the system. We have gone from 0.25% in the Fed funds rate to 1.75% in the span of 3 months. That's a 7-fold increase. We've never seen that before. You can't make a comparison to the early 80s when interest rates went from 10, Fed funds rate went from 10 to 20%, which was only a 2-fold increase. You just can't make that comparison. Well, yes, I can. I can make that comparison up 5-fold very quickly. And I think the Fed has panicked, and it's causing the economy. Now, one of the reasons we don't think this is going to be a problem is because of what happened a little more than a year ago with the ARK blow up. Apparently, one bank didn't know the amount of leverage that Archegos had taken on. And this was true across the banking system. And so that's how that situation became so leveraged. I think risk officers are now looking for excessive leverage. And so we would be surprised if there is going to be a systemic risk. But we do want to note that the concern is out there and it is elevated.
Thanks for watching. Until next time, smash up the like button, leave a comment below, and we'll see you tomorrow, friends.